Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Larry MacDonald. He is the founder of the Bear Traps Report, and he is also has a new book out called When Markets Speak. It's #1 on Amazon in wealth management and the economic categories. How are you, sir?
Good. Great to be back on Wall Street Silver.
Yeah, it's always great having you on. I wanted to bring you on to talk about, the book. Congratulations on the book. It's #1 in these on Amazon on these certain categories, so great job. And I also wanted to talk to you about gold, silver, all the hard assets, everything happening in the market. First, we'll start off with gold and silver. There's so much excitement now. Gold seeing new all-time highs. Silver starting to catch up a little bit here the past week. What are you seeing in the markets right now, Larry?
Well, so behind me, we run an institutional chat with about maybe clients in 20 plus countries. So it's hedge funds, mutual funds, and pension funds. And what I've been trying to do with the book is our first book was a New York Times bestseller. We did speeches all around the world, and we met so many talented asset managers on the buy side. In other words, people that are actually running the money professionally. And what we're trying to do with the book, When Markets Speak, is really democratize information. And so behind me, the one of the things that I'm hearing from the professionals over the last like 2 weeks, what happens is when the Fed, think about it, the Fed has not hiked rates for almost 9 months now.
Right.
And so they've been using the vocal cords aggressively as inflation kind of comes back up. But at the end of the day, the beast in the market, that serpent inside the market, doesn't believe any type of hawkish spin because they think that, okay, interest on the debt is already, if you go higher for longer from here, is $1.4 trillion over the next year.
Right.
That's an enormous problem in Washington. And Washington politicians show zero tendency toward any kind of austerity. They're all smoking, drinking the Kool-Aid. And at the same time, you get an election year.
Yeah.
And, the average consumer, the bottom 60% of Americans is in extreme pain because of high interest rates. Just look at credit card rates approaching 23%. That's like 7 or 8% more than, let's say, during 2007, the last time interest rates were up here. So the
Yeah.
credit card companies, because of higher rates, the bottom 60% of Americans in an election year is in a lot of pain. And I think the market kind of knows that the Fed's going to get forced into an easing bias. And that's what's really giving you a lift to gold and silver and hard assets.
Now, what do you see? Like, there's so much turmoil too on the commercial banking side. People have been talking about, these banks like Bank of America and these massive banks in the US have so much, like massive losses that are not declared or they're gonna have to be declared soon and put on the books. But the losses are very bad, and they said that it'll cause like massive problems in the commercial real estate sector, and as well as some banks will collapse. And then Jay Powell himself last month said, uh, he doesn't see too much issues with the commercial banking side, but he sees more bank collapses coming. He literally said that in an interview last month. So what do you see on the commercial real estate side, Larry?
Well, the biggest thing to watch is the super regionals because they're large banks. Your Zions, your Comerica's, your US Bancorp is the fifth largest bank in the
Wow.
United States. Whereas the little ones, we will have a lot of those little ones go down, but it's the big ones. And so what we're noticing is the underperformance of those banks relative to the S&P is the most since Lehman or since COVID. In other words, you're seeing an extreme amount of underperformance. And when you look at these banks, they own, like you said, a lot of commercial real estate. And when you talk to institutional clients, two things you hear from clients. Number one is the regulators were embarrassed, right,
Right.
by New York community banks, the very collapse very fast. Signature banks, immediate very collapse. Obviously, Silicon Valley. So the regulators weren't doing their job. Mary Daly at the San Francisco Fed that whole team was asleep at the switch when Silicon Valley Bank went down. So now, because they have egg on their face, they're much more aggressive, and so the regulators are looking for the problems, and
Right.
the regulators Powell knows this. And to your point, what you're alluding to is Powell knows that if he goes higher for longer or he hikes rates, he will wipe out one or two big super regionals. And we saw this in, say, the fourth quarter when rates were really getting up there at the high end on terms of 10 years and 30s. And like you said, all of that interest rate risk that's on the bank balance sheets. Powell, that really had a lot of banks, like US Bancorp was in a lot of pain.
Yeah.
Comerica, these banks were down a lot back then. And so now they've bounced up because under the hopes of rate cuts. And so if Powell, for some reason, were to hike here, you would see an immediate both interest rate risk problem with the super regional banks, and then a credit risk. There's two types of risks. There's interest rate risk because as interest rates go up, bond prices go down. And there's an Apple bond that you and I talked about, Apple bond that's guaranteed by Apple, but just because of interest rates, it was issued at 100 and it's traded in the high 50s, low 60s, 60 cents on the dollar.
Wow.
That's your interest rate risk. So interest rates up, bond prices down. And then you've got credit risk because a lot of people are working from home. You get a whole bunch of problems with commercial real estate because of different stresses in different cities and people moving away from the cities. And on top of that, the refinancing of these properties is just in a totally different realm, like literally. So the bottom line is that's got creeping credit risk. Don Peoples is a good friend of ours, major real estate player in the United States on the commercial side. He's been talking about this. And so, yeah, at the end of the day, Powell knows, and the beast inside the market knows that if the Fed were to hike, then they're dealing with a real bank collapse. And so the beast in the market knows that the Fed has to have an easing bias, and that's what's driving money toward these hard assets relative to financial assets.
And do you think there is a possibility he will? Like, because if you look at the elections coming up this year in November, do you think there'll be pressure from the White House on Powell and the Fed to not, even if, let's say, inflation does go up and everything's so uncertain with the war and you don't know what happened with the oil routes that's in the Middle East, and anything could happen, or any more war can break out. So what happens if inflation goes up and Powell has to do something? And like you said, if he does raise hikes, then you're going to see some massive issues and stress in the markets and in the commercial side. But what would the White House do? Do you think Biden would have to would pressure him, or does the White House have no control over the Fed?
Well, one of the big points of our book, When Markets Speak, is if you think about 2008, 16 years ago today, I was working on the outline for our book, A Colossal Failure of Common Sense. And so we were basically putting together that book. And what we talk about in both books is that the 2008 banking crisis essentially had a huge impact on the presidential election. In other words, it was McCain versus obviously Obama. Obama was an incredible candidate, from a marketing perspective.
I remember that as a kid.
Oh yeah, he was coming on strong.
Yeah.
But make no mistake, the banking crisis helped him. And so the Democrats know that a banking crisis to an incumbent administration or an incumbent party is really, really, really bad. And so what they've decided, and behind the scenes in Washington, we have a lot of friends on the Hill. We were down there all the time with our partners, ACG Analytics. At the end of the day, they've got a choice. They can try to work on unemployment, keep unemployment down, the best they can by doing massive fiscal spending. We're up to almost a $2 trillion deficit this year. Look at government jobs and the payrolls that just came out Friday. Massive increase in government jobs, a lot of part-time jobs. And so underneath the surface, the economy's struggling, but they're keeping it up with a lot of government spending. And they're basically saying, okay, we can go after jobs or we can go after inflation. And they're choosing to run out the clock. Between now and say November, they're going to only worry about jobs. They're going to let inflation kind of bounce. Powell's already thrown a lot of rate hikes at inflation. And that's the game plan, is that they're going after, they want to keep unemployment low into the election, and because they can't fight both, and they're just going to kind of let inflation run a little hot. And once again, remember what we talk about in the book, that's financial repression. So when interest rates are below the rate of inflation, when interest rates are kept below the rate of inflation, that's how you wipe out a $36 trillion debt. There's only one way out of a $35 trillion debt hole. It's it's a debt jubilee, which is a massive default, or financial repression, and that's simply when you just keep interest rates below the rate of inflation.
Wow. Yeah, that's pretty crazy. We're living in crazy times, especially with all the money they print. I heard the debt servicing is going to be so unsustainable soon that it'll be more than military spending and healthcare spending and like how crazy is that when you look at that, Larry, the debt servicing on the 33 trillion that the US has printed, like the interest rate payments on that is going to be unsustainable in the next 5, 10, 6, 7 years, however long. But they can't kick the can down the road forever. So what do you see there with the debt servicing?
Well, that's where the Fed's going to get forced into some type of quantitative easing, and that's where they're basically buying bonds or suppressing. That gets into financial repression. So
Right.
when you because the interest is right now, if when the Fed says higher for longer, right? It's all hot air. It's just BS. Because if you do go higher for longer, that's $1.4 trillion of interest, like you said. That's much bigger than the defense budget. It's much bigger than Medicare or Medicaid. And so higher for longer essentially creates a huge, huge vacuum hole, big financial hole in the federal budget.
Right.
So what they're going to have forced to do is they'll be into some type of QE a year from now where they're holding down rates, buying bonds at below the rate of inflation. And in that kind of world, what we talk about in the book is there's two types of portfolios. The 2010 to 2020 portfolio was a disinflation, deflation portfolio.
Right.
Financial assets dramatically outperformed hard assets. And in a certain deflationary world, you want to be in growth stocks. You don't necessarily want you don't really want to be in commodities. But in a world where inflation is certain, where you've got this creeping financial repression,
Right.
where inflation is up here and they're suppressing bond yields, that is financial repression. And that is where you want to own hard assets. So you want to own value stocks. You want to own your Rio Tintos, your silver miners, your gold miners, your Alcoas. There's all the, your oil and gas. You want to own companies that own assets because those assets will protect you somewhat against inflation.
Would you look at like what are you more looking at for the silver and gold miners? Are you looking at producers, explorers? What would you do right now as the precious metals market is going up?
Well, the first thing that a lot of professionals are talking about in the chat
Right.
is the reason why gold is dramatically outperforming platinum, palladium, and silver is at the beginning of a bull market in commodities, people pile into the mothership, the most liquid instrument, the biggest, most liquid instrument. And central bank buying is creating this, like a lot of what we're talking about in the book is when you use sanctions really aggressively over a decade, you push other central banks around the world away from the dollar. So what we're seeing is we're seeing a massive increase in gold ownership from the central banks, but they're not touching the silver, the platinum, the palladium, and some of the other metals. So you're creating like the spreads right now on a ratio basis between platinum and gold is literally 30-year wide. So in other words, I think right now you want to be shifting from your gold into things like silver and platinum. Remember, think about gold. What they talk about is all the gold ever mined in the world can fit into an Olympic swimming pool. Okay,
Yeah.
so picture in your mind, you're in this pool, it's 20 feet deep. All the platinum ever mined, if you were in that same pool, would only come up to your ankles.
Really? No
So
way.
yeah, 30 times more rare than gold. So, but and the gold to platinum ratio is at close to 30-year wides right now. So everybody's hiding out in the mothership. And the right now the ratio between gold and silver is still like an 83 handle. That's
Mm,
crazy. I mean, so the
that's
gold's
right.
83 times silver. And historically, in a normal bull market with commodities, that ratio should be in the 30s, maybe even a little less. And we've seen it even into the 20s. So that's the big spread. Sell your gold and buy your platinums, palladiums, and your silvers.
Yeah, no, that's it's so great having you on, Larry, to talk about the whole market and gold and silver. But before you go, where can people connect with you?
Well, first, I really appreciate the book. I mean, When Markets Speak, it'll walk
Yeah.
you through all these changes. And then on On Twitter, we're at Convert Bond. You know, we've been there for years. Our weekly report is the Bear Traps Report, where we that's our website, thebeartrapsreport.com. And what we do is we kind of recap. We're really democratizing information. We recap the conversation that we're having with the institutions
Right.
out to retail and high net worth investors around the world.
Yeah, no, it's super exciting. I'll put all the links in the description below, and I'll even put the book there when markets speak, and then so people can get it right on below us. But again, Larry, yeah, there you go. It's actually a very nice cover. I love the cover.
Thank you.
Nice and simple. I'm super grateful to have you on Wall Street Silver, and hopefully as the market develops, we'd love to have you back on.
Thanks, Ivan. Really appreciate it, my friend.
Awesome. Talk to you soon.
Yeah.